Uh, Hello, good evening, all. I'm Abhinav Chandra. So today I'm going to talk about. Let me just share the screen. Yeah, yeah. So today we're going to talk about the goal of market, financial management. So financial management goals is to increase the current value of the company's stock, and that increases the interest of shareholders and financial managers. And the aim of this objective is always long-term shareholder value rather than the short-term profit and market share. And the financial decisions are carried out keeping the future value of the company in mind. So it concerns the assessment of the investments, capital structures, and the managing of working capital on risk minimizing basis and generating the highest possible returns of the shareholders. And the firms are attracted by the investors, enhance their market position, and secure financial sustainability by prioritizing the stock value maximization. Growth and risk should go hand in hand, such that risk can be maximized to create more value while the focus remains on the short term profit. And if I have to talk about the cash flow from the assets, so the financial manager take the metric cash flow from assets as the critical one, which represent the entire cash a company makes from its operations and assets, but less investments in capital expenditures and changes in working capital. The cash flow assets, the cash flow to creditors, CFTO, plus the cash flow to the stockholders, which is CFSO, uh, or the NCS, and the changes in net working capital is used to calculate it. And the formula outlines the significance of understanding the embodiment of the difference between a company's actual cash generate and accounting profits, which has a direct influence on the firm's liquidity and the ability to meet its financial obligations. And a positive CFFA means a firm is replacing the amount of its debts, obligations, and stockholders' returns already taken, which is a key sign of the financial health. And yeah, the ratio analysis, it is an incredibly useful method for taking a company's complicated financials and translating them into a data every person can understand with at least one metric. And the current and quick ratios, like all liquidity ratios, depict the business capacity to deal with the fleeting responsibilities. And long-term financial stability is assessed based on the solvency ratio. For example, debt to equity. Other profitability ratios like return on assets ROA and return of equity ROE are used to assess the degree of profitability generated from the company's assets and equity. Inventory and receivables turnover ratios aid understanding about the efficiency in using the resource in terms of generating the sales. The last market ratios, such as price to earning P by E ratio, show how the market sets the value of the company. Point out that these ratios are no one piece of puzzle. They add context while looking at over time or relative to the other companies. And the sustainability growth rate, you can see the formula SGR, return on equity, ROE into the business retention rate. So the discussion of financial planning and the sustainability growth rate refers to how much a company can grow its sales and assets by using only its internally generated funds, retained earnings, which we can use it as another meaning. So while maintaining its current financial structure, such as the debt to equity ratio, such as it allows business to plan growth without the requirement of more external financing, reducing ownership dilution or increasing the financial risk. The amount of the net income invested in the company is calculated and multiplied by ROE to obtain the SGR, which is sustainable growth rate. So the example of Tasha's Toy Emporium, SGR of 17.14% demonstrate that this company can multiply assets and sales without externally financing by such percentage. It is crucial to stress understanding and managing SGR as it provides a basis for ensuring that growth can be self-executed within the limit of what it is feasible. And the future value and compounding are very important concepts in finance to show that the investment grow with time because of accumulation of interest. The formula is used to find out the future value where the principal is getting the interest at the certain rate from a particular time. And one important thing to note is that the compounding works by calculating the interest across all the initial principal plus the interest accumulated in the previous periods, and therefore it leads to an exponential growth in interest. And the interest calculated on the principal is larger in compounding than that of the simple interest, which only leads to further value of the principal. For example, the simple interest of $1,000 invested at 5% for 2 years would be 1100, while one $1,102.50 is generated when the interest is compounded. So this demonstration is the magic of compounding and the reason why compounding should not be overlooked on long-term investment strategies. And multiple cash flows, the process of calculating the future and the present value involves many cash flows. Okay, and the future value FV is a cash flows with the growth or compounding interest computed so that the total amount at a future point of time can be ascertained based on individual cash flows at the time set. And the other hand, the discounting of future cash flows to the present required a discount rate, and it is used to compare cash flows at different times. All right. And the bond valuation, the value of bond is dependent on its future cash flows, which includes periodic coupon payments and repayment of the principal at maturity that have a present value given a bond's price. The interest paid to the bondholder is fixed by the coupon rate, whereas the bond's price is determined by the bond's relationship between the coupon rate and yield to maturity. The YTM is the yield to maturity is higher than the coupon rate, then the bond is trading at a discount, so its price will trade below par value. And however, if the YTM is less than the coupon rate, the bond would trade at a premium about its par value. It entails the sum of the annuity of a coupon payments and the sum of the par value, each of which is discounted to the present at the YTM. And it is important to understand the inverse relationship between the bond prices and the yields to understand the effect changes in the interest rate in the bond investments. So that is about the bond valuation. And this is we talk about the common stock valuation. Mostly the valuation of a common stock is based on the present value of expected future cash flows, which comprise of the dividends and the selling price potential. And the cash flows contains the dividend paid to the shareholders as well as the capital gain from selling the stock at a future price. Future dividends and selling prices are discounted for the present value to find out what stock's value is. So using the required ROR, rate of return, this is shown in the one period example whereby the present value of a $2 million dividend and the $14 selling price is with required return of 20% yields a present value of $13.34. So the process is extended for holding period greater than 1 year to account for the future dividends and the various selling prices. The dividend growth model DGM is a critical tool in this process where the price of the stock is determined by the formula which is PO equals to D1 by R minus G, with D1 representing the next year's dividend, PO is the price today, and R is required rate of return, and G as the dividend growth rate. So this is how you value the common stock valuation. So the net present value, which is NPV, is a method of measuring the value ordered by the project, calculating the value of present cash inflows expected over the project life and comparing it with the initial investment cost. To compute NVP, the future cash flows are estimated and then discounted using the required return which is discount rate that reflects the project's risk. Consequently, the result is the NPV, which is the decision rule of a project, since the NPV of a project should be accepted whenever it is positive and be rejected when it's negative. The advantage of NPV is that it takes into the account of all cash flows, uses the concept of time value of money, and directly reflects to the end objective of earning shares, wealth. Nevertheless, its accuracy relies on the degree of accuracy of project cash flows and has more of the overhead of calculation than simpler methods like the payback period. The positive NPV, as it in the case above, means that the project is likely to add it to the company's not profits and it is a good investment. And evaluating NPV estimates, which is an important concept within the analysis of the profitability of a project. NPV is a critical metric. However, it is very sensitive to change in the projected cash flows. Risk forecasting arises from the uncertainty of the future cash flows, and the higher the NPV sensitivity on such future cash flows estimates, the higher will be the risk of the failure to estimate the value of a project. Finally, one should know the sources of value that contribute to NPV, as that contributes to the project success or failure directly. And with the use of scenario analysis, the best and the worst case scenarios helps in viewing the possible range of outcomes and provides the understanding of the effect of changes of revenue or cost in the overall NPV. So this is a process to figure out the robustness of a project financial forecast, importance of the right estimation, and how can one reduce the forecast risk and can improve the decision making. Uh, Thank you so much.